Good afternoon. Happy Friday, April 5th. Mark Milam here. Let's get right to what happened this past week. Well, most of the damage done on the first day of the week. We can see April 1st here, a heavy sell-off in mortgage-backed securities, rates worsening on the day. And ever since then, we've kind of been in this back and forth window of rates improving, rates deteriorating until we get here to Friday, April the 5th. A lot of this around economic data as it pertains to the labor market. Labor still very, very strong as the data would suggest. Unemployment rate ticking down today. No surprise there. We don't anticipate we're going to see some sort of collapse of the labor market. There's just simply not enough workers out there, and the economy remains resilient. So we see this upwards pressure on inflation as a result. That's keeping the Fed funds rate elevated and the prospect of rate cuts a little in the dark or at least unclear, and our Federal Reserve is really not doing much to help that picture. And we saw that this week in a very pronounced manner. Let me show you what I'm talking about here. So earlier in the week, Minneapolis Fed President Neel Kashkari raised the prospect of 0 rate cuts. That's a big shift from a couple of months ago when we were talking about maybe 5 to 6 Fed rate cuts. If you scroll down the page, he says if we continue to see inflation moving sideways, then that would make me question whether we need to do those rate cuts at all, Kashkari said on a Thursday interview this past week. This is Mester, Fed President Mester, who says it's possible that data may support a June rate cut. So she said that on April the 2nd, which was Tuesday of this week. So she's talking about a rate cut as early as June, just a couple of months from now. Kashkari is calling into question whether we're going to be cutting rates at all. Federal Reserve Chairman, back on March the 20th, was still talking about foreseeing 3 interest rate cuts this year, despite a bump in inflation. And then finally here is Fed President Raphael Bostic from Atlanta saying he's only seeing 1 rate cut this year, and that's going to come in the fourth quarter. This article coming out on Wednesday, April 3rd. So in the matter of 1 week, we have 4 different members of the Federal Reserve, each supplying contradictory information about what we think is going to happen with Fed rate cuts. This is an individual I follow on Twitter who said, hey, 11 minutes apart today, we had Fed member Goolsbee saying that if housing inflation, meaning shelter inflation, does not come down, it's going to be difficult to return inflation to 2%, which is the Fed's target rate. The Fed member Barkin says it is conceivable that 2% target is met without shelter inflation returning to what were considered normal levels. So when you start talking about contradictory statements, you don't have to look any further than that. 11 minutes apart, we have 2 members of our Federal Reserve saying exact opposite things. Meanwhile, we've got multiple members of our Federal Reserve talking about very, very different interpretations of are they going to cut rates, and if so, how many and when, right? And what does this kind of uncertainty or contradictory information create? And well, it results in rocking our markets, including our stock market. Right here from the street, this is an article published yesterday, said Fed members updated interest rate outlook rocks market. And we could see that the Dow Jones went from being up 294 points at one point during the day, down another 530 points later in the day. We're talking about an 800-point swing in the Dow Jones, thanks to these comments by the Fed. Another article here from CNBC says the Dow closes down 500 points. This was yesterday, and that was its worst day since March of 2023. This kind of contradictory or confusing information that just puts a cloud over what the Fed is going to do is definitely not helping any market at all. They would be much better off served of just keeping their mouths shut, or at least having a statement that is unified versus going out and sitting in front of microphones and giving these contradictory statements throughout the course of the week. As it pertains to inflation, though, there's some really interesting information that we want to close with. And this is sort of a projection of where we think we're going to see inflation go. And I'm going to go back to Jim Bianco, who's got some great math here. And when we start talking about year-over-year consumer price index, we're really just adding up the last 12 months of month-over-month data, right? Inflation is published month-over-month, and you add that up for the year-over-year data. And what the Fed says is they want that year-over-year data to be at 2%. Well, the problem is when you look back over those 12 months, we're about to start rolling off some of the months that had the lowest data in there. I'm going to show you back on this chart that March, April, May, and June, and July of 2023 had some of the lower month-over-month inflation data, and those months are about to start rolling off. And we're going to be adding new months. Now, no one knows exactly what the new months are going to say, but if they don't reflect these kind of figures here, it stands to reason that we're going to see the consumer price index tick up as we move through Q2 and on into Q3. For that reason alone, we can state that inflation is not likely headed back down towards 2%, and that if the Fed's not going to start cutting rates until they see inflation at 2%, we could be in for a prolonged period of higher Fed funds rate. That's why we have been calling on the Federal Reserve not to cut rates, but to pause or cease quantitative tightening. That's the process by which they're rolling off treasuries and mortgage-backed securities to the tune of $60 billion a month, which is creating upwards pressure on mortgage rates. It's increasing the spread between the 10-year treasury and the 30-year fixed. All of this is no fun to talk about at a cocktail party, but if you want to know who it's impacting every single home purchaser out there, and it's reducing their affordability. And one thing the Fed could do right now that doesn't involve cutting interest rates in an uncertain inflationary environment is to pause or stop quantitative tightening. We're calling on the Federal Reserve to do that sooner than later so we can improve affordability for mortgage interest rates and help our clients buy homes. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.